Hey traders, welcome to Charts and Coffee FOMC edition. We have the FOMC coming up. There is really nothing else to talk about in terms of what it is that we are all collectively going to be dealing with. So whether your time frame and time horizon, by the way, what's the difference between the two? Time frame. What is the setting on your chart? Is it a 5-minute chart, a weekly chart, 1-minute chart, hourly chart? What is the interval of each candle, right? And then time horizon. Well, that's related because if you have a 5-minute chart, this is not a time frame that's going to guide you through days or weeks. It's probably going to guide you through the current session, maybe the morning, maybe the afternoon, right? An hourly chart, time horizon's longer. Daily chart, even more length, right? Weekly, now we're talking weeks, if not months, sometimes years, right? So time frame, time horizon. The FOMC is going to affect all of it. It's one of those unique hot zones, high impact, high volatility, psychological events that can change opinion or accelerate really across all time frames and time horizons. A 5-minute time frame is really not going to have the ability to likely deal with the volatility at 2 and 2:30, by the way. The bigger fireworks are 2:30. And why do I think that? We're going to get a 1/4 point hike. Let's just get right to it, shall we? And if you have any questions, feel free to type them on in, but we're going to get a 1/4 point hike. Now, I don't say that from the perspective of wanting to predict what's going to happen. That's not my goal at all. Let me bring up my web browser here. That's not my goal at all. I'm not trying to say this is what's going to happen because I think so. This is really a function of, let me take on over here, the Fed fund futures and what this communicates from us, traders and investors, to the Federal Reserve. Believe me, when they open up their Bloomberg terminals, they know exactly where these Fed fund futures are sitting in front of today's event. Powell is crystal clear about the fact that nearly 85% expectation sits with that 1/4 point hike. Look, this is a guy that not even 2 months ago wanted to let the world know that the US central bank was still hawkish. A little regional bank crisis completely took the wheels off that wagon, but ultimately that's where he was not even 2 months ago and had to change and sort of reduce that hawkish messaging in the last 2 months. Well, the regional bank crisis, the financials, now he gets to look at the lay of the land and say, do I revisit that or not? And if he knows that we, through the Fed fund futures, are okay with a 1/4 point hike, believe me, he's going to hike. There's no reason for him not to hike. In fact, can you imagine? A lot of folks have said, Rog, I've heard that the Federal Reserve is going to cut. That's some ding dong talking about what they think and not what they see. We live in the world of trading what we see. We look at the data and we ask ourselves, if you were Jay Powell and you still wanted to hike rates and you got a green light, 85% green light from the trading and investing public saying, look, we may not like it, but we're okay with it. Would you not take the opportunity to hike? Of course you would. Of course you would. What gets trickier? All right. What gets trickier is that as we go out into June, as we go out into July, do we sit at that 5 to 5.25%? I will say, if someone said, Rog, I get it, you're going to read the data, but what do you see is a likely scenario? If I'm Jay Powell and I'm looking at the Fed fund futures for June and July, they're bonkers. I would sound hawkish. I would sound mildly hawkish because the June and July expectations for even, for July to even start to make a significant move for a rate cut in July is ridiculous. So if I'm Jerome Powell and I'm looking at these Fed fund futures at 1:55 p.m. Eastern, I'm thinking I need to set this course back to 5 to 5.25 through summer and then adjust expectations for a cut maybe in September, likely in November. And that's where, again, looking at the data, looking at where Jerome Powell was 2 months from now, and looking at the average target rate probability over the last 6 to 12 months, this is, again, this part's my opinion based on those data points. This is too dovish. The Fed fund futures are sitting too dovish. If there's going to be a disappointment, it's going to be that Jerome Powell is not giving a nod to something as ludicrous as a July rate cut. Very unlikely. All right. September, November for sure. So I think what he's going to have to do is push those expectations for that Fed pivot out to the latter part of this year. And again, if he can keep the hold in place until the November 1 meeting, I think he'd prefer to do that based on the data we're seeing. Now, that's not all. Tomorrow we get Apple. Friday we get non-farm. Any one of the events, Apple, Federal Reserve meeting and statement, and non-farm, any one of those things would make for a significant week. We've got all three of those this week alone. All right, so that's where we sit, gang. That is the story, and really anything else is going to take sort of the back seat to what it is we're dealing with today, and that is the hot zone of the Federal Reserve. All right, and remember, the press conference starts at 2:30, and if Jerome Powell wants to clarify where he sits, it's the 2:30 event that's going to matter. Also, take a look at the statement. There'll be an immediate reaction to it, but there is a very cool statement tracker from the Wall Street Journal that shows you last statement to this current statement and what the changes are. The algorithms will have responded long before we're reading through it, but it will at least give you an idea of where those adjustments have been made and whether or not Powell needs to clarify going into 2:30. All right. So with that being said, as always, gang, thank you for being here. And let's see. Good morning. Good morning. All right. Let's see. Penelope asks, hey there, Penelope. What are the moving averages on my grab candles? When I click them, it doesn't say red, blue, green. So the moving averages on the grab candles, the candles themselves aren't where the moving averages are at. They color code in accordance to where price is. So here's the moving averages, Penelope. They color code in relation to where price is based on the 34 EMA on the high, so the 34 period exponential moving average on the high, on the close, and on the low. So I've got three EMAs I look at, the 34 period exponential moving average on the high, one on the low, and one on the close. And then based on where price is in relation to those three is where the colors from the grab, the green, red, and blue candles, the grab candles, come from. All right, thank you for the question. What in the world is happening with crude? All right, let's jump on in. Crude's an interesting market. It has a central bank of its own, if you think about it. That's OPEC. That's OPEC Plus, actually. They have a central bank of their own. And if we know that the production cuts are still in place, there's no reason to get too bearish on crude. Another part of crude story is not just going to be a reduction in supply. That's one way to keep prices elevated. But gang, at the end of the day, healthy moves in crude, uptrends in crude really rely less on a production cut, right? Reducing supply, and more on demand, right? That's the best kind of uptrend in crude. And rarely do production cuts create an uptrend. They'll put in a floor, they'll establish support oftentimes, but they're very unlikely in and of themselves to create the uptrend. We need demand. So there's probably a demand narrative, Jay, that's running through, which is lower demand. Think about what demand is, right? What's the different way of saying demand? Demand is support. Demand is a floor, right? That horizontal level we can draw on a chart. So it's support, it's a floor. What is demand really? It's buyers, right? That's who creates this floor, the support, the demand, buyers. Those are all synonymous. So whether we want to call it a buying level, a support level, a floor, or a demand level, it's all the same thing. And if that level is accompanied with volume, price-based volume, all the better. But I want to mention this as well, Jay, is crude throughout 2023 has not been in an uptrend at all. And if you take a look at where it was rejected, as we persist in this chop, this yellow, neutral, non-trending environment, as we persist in this chop, one of the issues that we're going to have is that when we get to the 200 exponential, it's a moving average that I prefer. We get to that 200 exponential. Sorry, I forgot my clock up here today. That's going to be resistance. That's going to be a ceiling. That's going to be sellers, right? That's going to be what is going to stop the market in its tracks. So when we have support, there's resistance, right? Where there's buyers, on the flip side, there's sellers, right? On one side hand, we have demand. On the upside, we have supply. So even with the production cuts, if the supply is still greater than the demand, down it goes. And that's the way I look at that. Now what we want to do is ask ourselves, where is potential support? Where could we be oversold? And I do see, whether you're looking at the neutral environment, an oversold slow stochastic, the daily price movement range, or heck, just the previous lows, and you can see the automated Darvis 2.0 drawn right in there. Somewhere between, I'd say, $67.5 and $64.5 a barrel is where, if we're going to see support, the floor, the demand, the buyers step in, that's where it's going to be. And probably maybe some kind of news coming out of OPEC, because they don't want prices down here below 70. They do not. All right, let's see. Jim mentions, I indicated the 5-minute is not likely the best chart for 230 fireworks. What's my thinking and why? What would be a better chart? So remember, historical volatility, which is something that I rely on heavily, most of you know, created the hourly price movement range, the HPMR, created the DPMR, the daily price movement range. Gang, these don't exist outside of Simpler. These are ideas that go back and say, look, there is a historical price movement range, hour by hour or day by day, in every symbol. Can we go back, we curate that data and find what the typical price movement range is for any symbol? Now, for the 5-minute, I'll do that on the hourly. So Jim, here's my thing. This is a 68% probability. 2/3 of the time, roughly, price will respect the volatility resistance, that's the red zone, and the volatility support, that's the green zone. But that leaves another 1/3 of the time where, if there is action outside of the historical volatility norm, that's 68%, that's kind of the level at which things are outside the norm, right? I know that these levels may not hold. Every trader, when they create an indicator like I have here, has to acknowledge there are certain environments that that indicator is not going to do as well in, right? All of us either need to acknowledge this. Every indicator has an environment that it is better suited to, right? I just like to be upfront and honest about those things. There is no way that this indicator during an FOMC, during the press conference, is likely to stay measuring, right? If I think about it this way, if I look back on 6 months of 2 p.m. action and 2 to 3 and then 3 to 4 o'clock action, today, am I going to presume I'm going to stay in that historical volatility norm, or am I going to exceed it, right? That's the thinking. We have to be really honest about the strengths and the weaknesses of every one of our indicators. And that's where I say, okay, Rag, I created this thing. I understand what its Achilles heels are. Every indicator has one. I know that if there's an event on the calendar that's likely to exceed historical volatility, FOMC probably is one of them. Now, that doesn't mean we can't use volatility. Not at all. We just adjust, right? I mean, I can't drive on the highway in second gear. I'm going to blow the motor up. That's why there's third gear and fourth gear and fifth gear and sixth gear. Yeah. All right. What I'll do instead is I'll say, okay, what gear do I need to be in? I need to be in a longer term time frame, like a 1 hour. And rather than looking at hourly price movement range, hourly historical volatility, I'll just shift up to daily and say, I need something that's going to be able to absorb this bigger move at between basically 2 to 3 o'clock. And that's where I go to the daily price movement range. That's where I'll transition over to a 1 hour chart or a daily chart and look at a historical volatility that's measured in a different way, that's curated in a different way. So that's the way I adjust for that, Jim. And I think it's so important that we be really, really frank with ourselves about, what is this indicator designed to do? When is it going to work the best, right? And how do I use it? And it's kind of going back to golf, right? I've got a putter in my bag that I love. I love it. It was actually my dad's putter. The thing's quite old. It's sentimental. All right. I love it. It's great on the green. It's useless to me pretty much anywhere else, right? And I think a lot of times we fall in love with an indicator. It has some sentimental value. And then we forget, are we on the green? Is this where I need to use it? I've got a driver that I love, right? It's great on the tee. Pretty much useless everywhere else. So I think sometimes we have to remember, do I need to reach for my favorite club, or do I need to reach for the club that's best for the shot. And that's kind of the thinking there. And the funny thing is, we know this in every other walk of life, but yet somehow the suspension of common sense when we are trading is unlike any other game we play. And by the way, gang, believe me, it's a game. There are rules, there are points, there are winners, there are losers, right? Know you're playing the game and then ask yourself which club is best for the shot. So I hope that makes sense. All right, next up is, oh, you know what? Let's go take a quick peek at bonds. I know I did not take a look at bonds in euro, and bond yields are up. Bond yields are up, gang. So that tells me bond yields are down while the bond futures are up. My bad. If bond futures are moving higher, ZB, TLT, those charts are moving higher, that's indicative of the yields, the actual percentage rate moving lower. I want to see TLT up. I want to see ZB up. Even more importantly, not that I keep an eye on it to trade that often, but this week it's pertinent. I want to see the 2-year yields up. They're the ones that are probably most closely tied to what it is that I want to do in terms of expectations of Federal Reserve monetary policy, hikes, cuts, etc. Right? So I want to be long at support levels in the notes, in the bonds. In fact, we're long the bonds. Just all my cards on the table. We continue to have a long position in ZB via the TLT ETF. So I want to keep an eye on that. I also want to see the US dollar down, which is to say I want to see the euro up. It's up. So not that Powell can't disappoint and upend this market. He has done that before. He did that on March 7 on day 1 of the Humphrey Hawkins testimony. That's when he came out really hawkish. And then not 3 days later, we had the regional bank crisis and people said, okay, that's not going to happen. He can't do that. He can't go on with those very hawkish plans. Right now, if I look at the markets that would indicate dollar weakness, lower yields, or even optimism in equities, 6E, ZB, ES. ES is at least holding support, which is something I would like. By the way, if you're checking out this week in the market, if you're checking out this week in the markets, you know where I'm looking. You know that a recession, by the way, I gave you all 2 big reasons why a recession is something that collectively we are not that worried about and why. I talk about the bunk that is sell in May and go away, how it's really not even interpreted correctly. In fact, if you check out the free video from yesterday, I talk about that quite a bit. Sell in May and go away. Come back on St. Ledger's Day. If you've never heard of that, check out the video. And then why the Halloween effect is really something we want to keep an eye on. All right, gang, that's a wrap. This is what we've got coming up today. FOMC, Apple tomorrow, non-farm payroll on Friday. Jay asked, the 6E has been rocking for months, 6A not so much. Why? 6E has a central bank that is hawkish. 6A is a currency that's very sensitive to commodities. We do not see economic expansion. Australian dollar, New Zealand dollar, Canadian dollar typically benefit. Calm dolls when we have economic expansion. That's it in a nutshell. Be good to each other, gang. I'll see you tomorrow. Same time, same station.